Drew, we up and running there?
Absolutely. She had the phone on mute. I was talking to my urologist. Actually, I was. We have some big plans, if you know what I mean.
Nice. Like the tunes. Very nice. Well, let's get started. Dynamic Directions. Welcome to this month's investment webinar. It's certainly exciting times. Our first down day in a long time. Seems like these webinars are pre-planned to be its timely methods. So we got a lot of things to get into. We're going to do a nice market update. We're going to talk about a lot of you had said, hey, I've got clients that they're saying the market's up, my balanced portfolio isn't. We're going to talk about how to fix that, how to enhance that. We're also talking a little bit about competition we're seeing advisors have, how to beat that. But Drew, let's dive right into it. What's going on in the financial world right now?
Well, John, we are keeping as busy as you could ever imagine. It's good things. We're rolling along. We have seen a little bit of volatility here, to say the least. Jack, there's here line's ADV behind. Once you get that, we can scan that in and put on PDF. But yeah, we had a little bit of volatility yesterday. I think some indigestions, perhaps, of things that may or may not transpire in D.C. And that reminds me, Miami, D.C. prefer Versace. So we hope to see everybody in Miami that's on this call. But what we've seen is probably what I would consider to be a little bit of a creeping correction. And that'll be kind of the start of the theme today is we've seen interest rates soften up a bit. So for Thompson users, the TNXUT is a great way to show what the 10-year Treasury yield is in real time. It's at 2.396, and we'll send that out to him. We'll get that later. We're going to find it. But basically, I want to kind of go over why that's important. So we've had yields come in after Janet Yellen's Fed meeting last week. They were almost, I think, 260, and so they're now down to about 239. And given that, let's look at some of these sectors, John, that have had what I would call a rolling correction here. Here's the Vanguard Energy ETF. Take a look at it. What you're going to see is probably at least a 10% correction here from the peaks of about 108 to the dregs of about 95 and change. You know, that's, by my back to that, could math about 12%. We're getting close to that in financials. Let me move my screen here. You know, you're looking at probably going from 64.23 to 59.77. Just real quickly, you know, that's about a 7% correction. So different parts of the market have kind of experienced what I would consider a correction already or in the midst of one, and I think that's a very, very telling point. Other parts of the market have continued to go to new highs, specifically led by the tech sector. You know, both mega cap and regular tech. We had a little bit of a come apart yesterday, but if you look at that chart, John, that's a pretty good looking chart there. So we will continue to watch other sectors. You know, here is healthcare. You know, they had a post-election a little bit of a sell-off, but then it's kind of moving up. But then we've had a move from roughly 160 to down about 3% here. So it's sometimes the way the indexes are built. You know, a client may think, hey, we're at highs, everything should be up. But if they're diversified, as you said on the lead into this meeting, they may not be experiencing a high on all cylinders either. My thought is probably, you know, your biggest components of the indexes are going to be financials. You're going to have some industrials in there as well, and financials and tech mainly. And so if your portfolio is a little bit more energy heavy, a little bit more tech heavy, If it's more value heavy, so if you're running the MDG portfolio and SIO, their numbers are not looking as good year to date as they did last year, because this has definitely been, since probably the second week in January, mainly a growth market. I'm not saying that that's the way it's going to continue all year, but definitely, we would see growth is taking the lead. Now, with rates kind of softening up, this is the Agg Bond Chart. It made a new low, but then it's kind of coming back up, broke over its 100-day moving average today. The taxable munis that we use on those funds, similar looking chart. The lows aren't as low, highs aren't as high, but essentially went back above the 20-day and 50-day moving average on that index today, with yields going lower. U.S. dollar has continued to sell off a little bit. And the UUP, that's definitely, the dollar's off its highs by around 10% as well. Maybe not quite 10%. Let's call it 2683 minus. They're down about 4% off its highs. So interest rates are kind of driving everything. I think what the bond market's telling us, John, is maybe not so fast on the economic conditions being absolutely perfect. But I think the longer term view here is going to be, more than likely by the end of the year, taxes will be lower, or the mechanism for taxes to be lower in 2018 will be put in place, and interest rates will be a little bit higher than where they are. And I think those are the key, basically, foundation stones for making investment decisions for clients and investment conversations for clients. So you need to be poised for investments that work well in a rising rate environment, but probably a rate environment that doesn't have to rise very, very quickly. And then investments that would benefit from a tax decrease, I think, are also a good wheelhouse place to be, such as financials. Most banks are paying the highest corporate rate you can pay. So a reduction there from 35 to 20 is almost a 50% reduction for them. And secondly, and probably more importantly, not only look at the stocks that would benefit as far as market cap, but also those same companies and how do they issue debt. And that brings us to something that we call here in Owensboro, Kentucky, convertible bonds. So this is a convertible bond fund. It's run by Mackay Shields. I think Mainstay promotes it. But essentially, if you look at the constituent securities in here, John, these are mainly issued by your mid and small cap companies. So if you agree with the premise that the tax cut helps proportionately, in a greater percentage, medium and small companies rather than large, why not use that same premise on your fixed income side of things? So that's who issues convertible debt. And so therefore, I think that's something worth looking at for everybody to consider as a way to protect their overall portfolio.
So as we go here, if anyone wants to pop some questions in the chat box at the bottom right, we'll keep an eye out for them. So great insights, Drew. What else are you seeing it work in this lower rate environment? A lot of rising rate environment. Some advisors are not only going to convertibles. I see some more short-term leveraging of some of the different instruments out there. But what else do you think should make up a solid portfolio for someone pre-retired, retired in that fixed income area?
Well, our mortgage fund, the JLS we use probably the most of, I mean, that chart looks different than any type of bond chart you're going to see. BCA had a really good article probably 2 weeks ago. They think, they're going to get, the Fed's going to be selling mortgages. This hasn't really had, that big of a negative impact yet, but this is a 2019 maturity. So essentially, what we've seen is basically, pretty good performance here. If these are mortgages that mature in 2019, if they were 10-year mortgages, they were issued in 2009, that's certainly rates higher than where we have now. People are getting close to payment. I wouldn't expect many defaults. If you're a year and a half from paying off your home, that's typically not the time that you default on your loan, unless you're just in dire circumstances. So I think short-dated mortgages, that's a place to look. I think probably as well in your taxable accounts, high-yield munis, because we've not really had any type of credit problems. I think we had a real long discussion yesterday about credit spreads. You're really not getting paid a whole lot now, but I think if those widen out and high yield stuff gets cheaper, that would be the time to look at those investments as well. They typically have done better in a high yield environment. You've got floaters, I think.
You talked about floating rate. You talked about floating rate last time that might be getting approaching overvalue. What's your thoughts there now at this point?
I think that chart's worth 1,000 words. It definitely doesn't. It looks, your floating chart is looking a lot like it doesn't even look that good as your municipals. So the floating chart looks a little bit like this chart at the end. Hang on, Thompson is going crazy. So I'm not so sure that floaters are an absolute. What's the OT? That's continued to go well. I think basically, if you're going to go with floaters, this iShares is probably better than that Blackstone product. Obviously, something went on there, and they may have somebody not pay them because that chart looks totally different than the rest of the charts. But LIBOR, 3-month LIBOR continues to hover around 1.15, 1.17. Most of these floating rate loans had floors at 1%, so we're above that now. And I think over the course of the year, short-term rates continue to go up a little bit. So that's the kind of no-brainer way to play it. And then I think I like convertibles a lot, and probably some high yield municipal debt. I wouldn't buy it today, but a little bit, later on when they get a little bit cheaper, you can kind of go into that space. That's the way I would look at that.
Very nice. Now how about on the equity side? We've had, such a big run-up since mid-November. For the first time, we've had a real headwind here. So you doing anything different in the equity side since we're just starting to hit some headwinds here?
Well, we're probably going to go in and buy either the VFH or the QABA. These are financial indexes. And community banks have already had a 10%, more than a 10% pullback. Because I think, they're getting a little bit cheaper. You're larger, if you like individual stocks, you can kind of go through here and see, let's say S&P's at an 18 PE, BB&T, just as an example, not saying buy it, Ford PE's 14. The biggest of all of them, JP Morgan, Ford PE 13.3, U.S. Bank, PE of 15, Wells Fargo, PE of 13. So, you can look at those areas and definitely see those are cheaper than the market. From a commodity standpoint, we like unleaded gasoline. You can kind of see I've been fiddling around with this chart, John, with my line drawn in here. I think gasoline is the most rigged deal in the business, and it may get a lot cheaper, but I think you've got a lot of price support in the mid to low 25 area, and that's definitely held up in that area. So if you've got clients that want to get some commodity exposure, other diversification that way, that this is definitely a good place to, that's what we've been using. I'll say that.
Nice. Very nice. Well, there's some tremendous updates here. As always, if you have some questions, just speak up, or we're casual here. Just pop it down the chat box. We'll keep an eye out for it. But really good insights to, I think, what's going on and what advisors should be thinking about doing. So let's switch gears a little bit here. I think there's been, I've heard from almost every advisor, they've had at least one client that said, the market's up a lot. My account doesn't seem to be up that much. And it's easy to see on the news and or talking to people that are more heavily in equities have done really well. Some advisors are using a more diversified or balanced portfolio where they're following like an IRG overall allocation or some other kind of allocation. And they just haven't performed well in the short term. And as you look back over the last 5 or 8 years since the recovery, I mean, we just hit the 8-year anniversary of the bottom of March back in 2009. So that traditional portfolio over longer terms does do well, but we've been in a funny period where it hasn't, and some clients are paying attention to that. So some of that could be expectation-based, where clients forgot that they're not all in on large-cap stocks. It may be some of that. But, Drew, what are your thoughts there for those advisors that are struggling with those clients that are saying, hey, the market's up, I'm not as much. What's going on here? What's your advice for some of those advisors?
John, I think one of the most important roles we play is that of someone who can bring perspective to people's financial situation. And so we've got, a half dozen of us on the call here. I think what you have to make part of your value proposition is maybe even every meeting saying, reaffirming what is your risk tolerance, and with that risk tolerance, do you expect to be invested differently than just the quote-unquote stock market? And assuming they say yes, then say, for your risk tolerance, here's how you're invested. And as part of this SPS Advisor project and asset allocation and all that, I think you're going to have to produce a model and just say, then here's what the model has done. Because I think if you don't benchmark yourself, someone's going to benchmark you for you. Okay? And I know that almost sounds like a Yogi Berra-ism, but I think, what we need to sell, and I think financial advisors, John, are great at painting the portrait, painting the oil. You come in and say, this is when I want to retire, this is what I have, and we orchestrate a nice impressionistic canvas and make the most beautiful picture in the world. But you know what we don't do, John? We don't frame it. We do not put a frame on it. We let them walk out of here, out of our shop, with literally a priceless, one-of-a-kind masterpiece, correct, Jacqueline? With no frame. So when they have it at their house, they could take it to some jackass frame shop and have a priceless painting with a stainless steel Hobby Lobby $6 frame. Or they can take it and have 12 inches of crown molding, gold, embossed, Merrill, Thurston Howell III frame. And neither one of those is going to look right for the picture we've done. So my analogy would be, it is incumbent upon us to get back to basics and quantify and qualify and put a frame on their masterpiece. And since I got back from Quantum, that is exactly what we've been doing. Our business literally has never been better. I've got 2 full-time people answering the telephone and processing business, and I need another one. So when you can frame it for your clients, the proper frame with their own masterpiece, you protect yourself from having just a bastardization done of the work that you've done. Because when we don't do it, the frame's going to be put on by somebody else. And it might be a frame off of Velvet Elvis hanging off of the, infamous Donald Trump 400-pound guy, hacker, sitting on his couch in his underwear, instead of from the Louvre or from the, Hermitage in St. Petersburg. So it is up to us to frame our own work as an artist. And that way we own it and we complete what we do. And it's also up to us to reevaluate that masterpiece with them at least once a year and say, okay, here's how we framed it the last time. Does this frame still fit given your other scenery and where this painting's hanging in your life? So that's one. I think too, John, where we've hit a home run is you need to get down to a granular level and show them the value that you are creating for them. Okay? Because I think if you look at all the Doll Bar and the J.D. Power stuff, and John, you go to these high-power meetings at Ameriprise, every time they get used to, somebody had $1 million with you, they called in, you could call them back in a couple days, right? Then their expectation is you could call me back tomorrow. Then their expectation was same day. As you move up market, guess what happens with expectations? So Jacqueline, when you buy the Range Rover, do you expect to have the same level of service that when you bought the Ford Fiesta?
Not so much.
No. So, when you're rolling in a big body Benz, you want the best. So when you get those best clients and they call in here, John, they want to be called back within a few hours. So it's no longer going to be good enough to say, hey, we set this up for you and it made you feel good. We're dealing with clientele that want to be made feel good all the time because they can afford to go to the spa and feel good all the time. They can afford to not just get Botox a couple times a year. They're getting filler, baby. So we have to be able to produce that same level of service, and you have to be able to quantify that. And the way you quantify it is when you came in, you were having your taxes withheld in this way. We changed the way we're saving you now, $2,000 a year in federal income tax. Here, look at this. When you came in, you were invested and you were paying T. Rowe Price $14,000 a year to have your money invested. You know what? You're paying us a lot of money. It's less than what you're paying T. Rowe Price. You were paying, I think we have to realize we are in a business, and the more up market that you go, I think what you're seeing is you have to be able to prove it. Because the other thing we need to consider is the people who are millionaires now weren't millionaires more than likely 10 years ago, and they're going to be wanting to see value. At Ameriprise, we're not dealing with a lot of, Richie Ritz that it was a trust fund, nobody's worked. The value of our business is we work with most of our clients earn their money, and they want to make sure that we're earning their money, doing a good job by them. So I think without a doubt, you have to be able to visibly demonstrate the value that you create for people.
Yeah, that's tremendously insightful, and I think that's exactly the gap that advisors are having. So if your clients are asking about returns, that should be the alarm should be sounding that is the gap right there. That is what you're missing. It's helping people interpret that value, what you've been doing, and Drew's right on that the biggest value we have is giving people input and giving them unbiased third-party input on where they're going in their money. And you have to help people understand that if they were all in on large cap stocks, that, hey, they could lose 43% in a few months. That happened in the last 10 years, and that could happen again. It could happen tomorrow. That value is huge, and I think you're right, Drew, that there's other things outside of their return that we need to help frame and bring to light to people so they can see that there's more value just beyond what their account did last year or so far this year. There's all these other elements and all these other parts of the lives that we impact for people. There's so many things that you can highlight and help people interpret the value because they're going to forget. And there was a lot of nuggets. I would really suggest going back and rewatching that last 6 or 7 minutes with Drew multiple times. There was a lot of great things in there. Response time to your top people. You're right on that. That J.D. Powers study really showed that the Ameriprise as a whole, the firm, a lot of you Ameriprise, there's people from some other firms on here, but as a whole, we've gotten complacent for getting back to people. There isn't that immediate quick response for your top people. It's, a day later or later that day isn't good enough. So lots of things to go back and work on when it comes to the value we deliver, the way we service those top people, but most importantly, how we frame things, how we help them understand what they have, and how it's in alignment with where the heck they're going. So,
and John, let's kind of dive a little bit deeper there because, if you've got people looking at returns and, my fees are too high, let's look at the dumpster fire that is T. Rowe Price. We've pulled their stock chart up. This doesn't look like any financial chart of any institution I know. What's going on here? Well, obviously, they're not providing good service. Something isn't going on. So either, there may be an outflows, et cetera. But when you're there again, about framing. When you're with your client and you call Vanguard, Fidelity, or T. Rowe Price to do the rollover, see how they handle it. 9 times out of 10, you're going to be talking to somebody that probably has had a job with them with very little tenure, very little knowledge, and once you get into just scratching the surface with complexity, your client who doesn't know anything about the business is going to basically thank you that they have you to help you with this because they're going to see basically the inability of our competition and what they're doing in what I would call the low-end space. If you're worried about robo-advisors, then I guess you're worried about Tesla's driving down the New Jersey Turnpike and the guy's doing Sudoku behind the wheel. God, that's the future. But here is the deal. What statistics show, what the financials show of these own robo companies are once people get to a certain level, and we can go back several years, and I've used the analogy, after Dr. Frankenstein built the monster, what happened? The villagers burned down the castle. Dr. Frankenstein is the husband. Frankenstein is the portfolio. They've built it over a working life, and when something goes wrong and Dr. Frankenstein can't control the monster anymore, either the wife or the kids are the villagers in this analogy with torches at the castle and says, Fred, get an advisor. Dr. Frankenstein, kill the monster, or we're going to kill it for you. So there again, do not be worried about that. Embrace it. Tell people, maybe that's the type if that's what you want and you expect for service. Because if people accumulate dollars, they will build their own Frankenstein, and literally the villagers will come to you with the torches and pitchforks saying, help us, Drew Watson. Take this beast in, put him away. So, that's what I would say when it comes to T. Rowe. Vanguard, sometimes, you get a little bit different breed there at Vanguard in their upper end space, but they will be quick to tell you when you know what you're doing, that you know what you're doing, and you're taking care of a lot of stuff for the client, and that will translate for the client. So, that's what I look at. The other thing that we have here is an ADV. Jacqueline will circulate a little bit of this. This is our main competitor in town. If you're worried about the fees we're charging, they're charging fees we can't even charge. That's how high they are. If I told somebody with $2 million, well, I've got to charge you at a minimum 1.5%. Well, good luck. I'd like to get it. But so I think the problem is most people don't know what they're paying. And I think you have to have some things to show them that even though they don't think they're paying anything, bring in all your statements. Most of our competitors are not even going to call their fees fees. They're going to call them other things. They show up as other adjustments on the statement. They don't even call them fees. It reminds me of Charlie Sheen and his non-HIV. It's a problem he has. So, John, I think what you've got to do with clients is have an open conversation and say, look, yes, you may not think you're paying anything, but this is what you're paying for. And that's why I want this DOL stuff to go through, because a lot of our competitors are getting away with basically less than full and fair disclosure. And I think have them clients bring you their ADVs. It'll open up a whole world of opportunities that they'll realize, John is really different. These guys, they're very different. We're seeing the world differently now. All the money about the funds or what money they're kicking back to people, that will all, the light of day will kind of, be out with all that. So you've got to have real tangible value. One of the things that we have to that vein is we've done away, with this. I think one of the things that you owe it to your clients to do once a year for your high-end clients is do a deep dive on their taxes. The lowest hanging fruit, John, in the tax world is, are there ways to build a better mousetrap and make sure they're paying the least amount of taxes as possible? Traditionally, what we've seen our competitors do that we've dealt with, not just in Owensboro, but John, as you know, we help offices around the country, everywhere from Carolina to Tennessee to Texas to D.C., is they'll just gross up their IRA distribution to take care of the taxes. Would you agree with that, John? You're a consultant.
Absolutely, yes, absolutely.
So a way to show value is to get down into the minutia and basically say, you know what, there might be a better way to do this. What we start with, if they're drawing Social Security or they're getting close, to say, okay, when it comes to your taxes and how they're paid, we've got a couple different options. And we go through this in detail. How does the Social Security work? This is part of our financial plan. What could they have withheld? But essentially, what we're able to do is show them is some ranges of tax savings we've been able to impact for people, and get down in the meeting and say, you know what, if you want to draw $9,000 a month and your Social Security is X, if we have 25% of your Social Security withheld for taxes, instead of grossing up your IRA for the same amount of cash flow, here's how much it saves you. Also, by the way, you can use this with a much younger couple on a financial plan deliverable, look forward-looking if they don't want to put money back in an after-tax account or a life insurance policy or a Roth conversion, because you can fast forward them in a Wonderful Life or Ghost of Christmas Future scenario to say, this is where you're going to be. You need to make the change of the tax treatment of the dollars now, because here's what the real impact will be 10 years from now, 5 years from now, 15 years from now. So these are real tangible ways, and you can kind of show them exactly how much you're going to save them after you work it up, but kind of have a little crib sheet, say, this is what we look at. For your little old ladies that don't really need a lot of money, you can always fall back to how do we keep almost none of their Social Security taxable, and then how much money does that save them? These are huge, huge value added. I would also say one of the things I would challenge everybody on here to do, get with a VA expert. I have had more people with $5 and $6 million get excited about getting $9 prescription drugs than making them $250,000 in 1 month. Let me go back to that. I've had more people with $5 and $6 million excited that somehow they could get a VA benefit they didn't think they could get. So this goes back to the something for nothing versus making $250,000 or $300,000 in a monthly statement. There's something about human nature, and it is, call it maybe the good shepherd, the prodigal son. The good shepherd would leave his 99 sheep on the hillside and go look for the one. A multimillionaire might forget about his $5 million for the moment if he thinks he can save, $25 a prescription beginning on. Find a VA expert in your area and make someone in your office a VA expert. Because one, it's going to make you feel good because these people have earned it by serving our country. Two, it's going to make you feel even better when you realize that there's literally no one in the VA department that really knows anything about these benefits. And three, it's going to make you feel probably go back to why you got in this business when you can help one family who's had a World War II, dad, he died, to figure out how the mom can access his benefits staying in an assisted living center. So those are all intangibles, but they lead back to the tangible that you're going to be an expert on something and show either them or somebody in their family how to access the benefit. The other thing that we've got that Jacqueline's going to send out is the now home office approved communication of how we help your whole family. So John, I want to bring this kind of full circle and square the circle here, is for your very best clients on your menu of services, we call that the integrated level. And people will say, yeah, we do work with your CPA and your tax advisor, blah, 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 blah. Do you think people at UBS say that, John?
Yeah. Everyone.
Everyone says it. But who says, I do work with your kids and your parents? Or if you've got this dowager aunt who never had any kids and you're the closest thing to family she has, I'll help her too, because I am never too busy, John, to meet with someone you care about. Now, that is integrated financial planning. That is not, well, I'm going to meet with your, lawyer and your accountant. These are people you probably see at the club when you're having a Long Island iced tea after a round of golf. These are the people that your clients care about the most, not their accountants and not their attorneys. So be an expert on VA benefits. Get somebody, I always hear, John, what am I going to do about these AFAs? What am I going to do? This is a great way to get your next generation advisor working with your next generation client. Who would have thought about it? At D2, we set for 10 years figuring this out, John. No, just kidding. But because what I found with the guys working with my second generation, they've become experts in student loan refinancing. That's the number one question coming in the door. Hey, my daughter's a doctor. My daughter's a pharmacist. My daughter's this or that. She's got 100,000 student loans. Can you help her? I can't, but this associate financial advisor, this is his bread and butter. Boom. It works every time. And what have we done? We've solidified the relationship. We've built a moat around the practice. We've fed an AFA who can't feed themselves, John. You know, how many times we've heard that. And we've done an absolute great job of going literally deeper to the nth degree within integrated planning. So, you know, for the advisors on the call, that's really kind of what I would talk about from a value added standpoint before we kind of go back into some investment stuff. Any questions, Jeff?
We've just got one popped up. Michael said, how do you track each client's annual tax savings from your advice you can share with the client?
Well, we have a special form, and it's a special color. It's money green, like a money green leather sofa. And in the meeting, I write it out in front of the client. You're going to get this in your financial plan. This paper's green because you know what it saves you? Money. It's scanned in green because we know it's important, and this will go in your financial plan. That's how we do it. So we have a, which Michael was that?
I'm not sure. It's Michael.
Okay, Michael. So we have a section for estate. Spirit, hi, Mike. Estate, taxes, investments. We've got probably 4 or 5 things on that form, John. I mean, Jacqueline can get it from Stephanie and send it out. And we just write it out. This is the strategy we used. This is the value that we created, and it's called the value created page. I need to change it to the, who's on the $100 bill page?
It pulls out the wallet.
Let's see. We're going to change that, John, to the Ben Franklin page. That's an executive decision here. So, so that's how we do that. One of the other questions, John, that we've been getting is, I don't want anyone to have to admit to this, but does anyone have people in their client book? I'm the only one, I'm sure. It never is good. It's always bad. If it's raining silver dollars, their shovel is too small. I have those in this practice. I'm probably the only one on the call that does. But for those who are just waiting for the market to implode, BCA came out with a pretty good report last week or two, and they call it Beware the Trump 2019 Recession. Okay? Fast forward to what I think is the most important part. So on this slide, the gray areas, is this all in color? Mm-hmm. The gray areas represent the recessions we've had since World War II. The blue line is the difference between the 3-month Treasury bill yield and the 10-year Treasury yield. So whenever these rates have been the same or inverted, where the short-term rate is higher, like down here, than the 10-year, every time we've had a recession. Not sometimes, every time. So if you don't have one of these, Grant and I made these up. We found this. I'm glad Ameriprise, they don't even give you this. You can go out to something called Google. It's something new. I hope you can. It's the Thompson Quick Reference Cards. So we need to probably take these to Miami. So basically what we need to do, because people say, well, how did you know this 10-year number and all this on Thompson? Basically, the thing to have up to be able to show your clients is that you're watching this. Because they really know you can't stop a recession, but it's worth something to them to know that you're watching it. So basically, we have the 3-month Treasury yield here, 76 basis points, and this is real time through the day, okay? And then the yield here on the 10-year, here's the US 10. This isn't as easy to look at because you've got this price, but I like the yield here, and then this is the yield here. But basically, put those up there. We're watching for the inevitable, canary in the coal mine. The direction of this stuff is unmistakable. Fast forward, they think 2019 we get a recession, but you want to be out of stocks before then. And this, right now the gap is probably about 100 and some odd basis points. If you want to be safer, John, than just the 3-month bill rate. Go over here, look at the 3-month LIBOR, it's 1.15. I think you look on the reference card, there's a LIBOR. Yeah, there's a 3-month LIBOR, it's BBUS, blah, 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 blah. I had the boys put that on there. So anyway, this is a great reference piece. I've never seen it before at Ameriprise, but it's available through Dynamic Directions. So, yeah, through Jacqueline Jordan at the Jacqueline Jordan Boutique. Now, that's kind of a Debbie Downer. What I'm going to get into next and kind of close is this scenario, which if you've been looking at your IRG, does everybody here get their IRG stuff? I mean, our friend from First Global, I don't know if they send out something, morning research notes in the morning, but basically IRG has been going, John, on factor investing, on the different factors they think work for the market. Well, that was a disastrous thing, investment news. And one of the factors that's really hot is, it's this chart coming up. Dividend Aristocrat. John, have you ever heard of that strategy?
No.
Neither has most people. Yeah. But anyway, I'm sure everybody on the call has heard, well, you should do Dividend Aristocrats. They've done. And so Ameriprise, I don't know, it's probably sometime this year they started putting this factor thing on here. What are the factors to investing? We were on the equal weight bandwagon back when I was coming in here with a members only jacket in like 1987 is how long we've been on equal weights. Dividend Aristocrats as well, it's well publicized. So what the guys at BCA did is kind of, they've looked through what's the best way to kind of get some of the smart beta dividend funds. Now, here's what's very interesting in this. Just before you go out and buy, I'm going to buy like the Vanguard VIG, okay? If you got any Vanguard fanatics in your book. Historically, longer term, going back to before the Great Depression, John, and before we had those horseless buggies and the wireless. So going back 90 years, this chart on the right side, you can see, dividend payers, highest dividend payers performed very well. In recent times, companies with no dividends have outperformed dividend payers by almost a 2-to-1 margin. Let's say that again. Non-dividend payers have outperformed dividend payers by a 2-to-1 margin. So, this is where I would basically let people know, be careful what you read, just don't jump in with both feet. It's not as clear-cut of a case that, hey, if I just buy the rising dividends, I'm going to do great. The last 2 decades, that has not been the case. So, there's really, the fast forward to, let's say, the ending of this story is basically dividend growth is not a bad place to be, but it's just another factor. There's, you can kind of see in the deciles here on risk-adjusted returns, I mean, there's not much difference between your highest decile and your worst. As a matter of fact, some of the under the halfway point are better than your best performing deciles. So typically what you've got to do is kind of dial down. They've got a couple ideas here. First Trust Rising, Dividend Achievers. I don't know if anybody uses that or not. And this other fund, but you can kind of see versus the Vanguard. So there again, if you've got people, well, I want to be in Vanguard because they're cheap. Well, I don't care to give somebody more money if I end up with more money. And I think that's the analogy that you need to be able to show people. And so typically, since these guys have been in business, this one is 5 years, this one's about 3 years, they've really put a pretty decent performance gap between themselves and old Vandy there. this is basically outperformed it by, 13%. This is Flex Shares, and then the other one is First Trust. So these are just a couple of ideas. You want these reports, like Jacqueline know, we'll send them out. We've got some mid caps, all that stuff. So John, just before, because I noticed that factor report had been on there, just realize that don't just jump in to buy the dividend, quote unquote, aristocrats, because you may not get what you think you're getting for your clients.
Tremendous insights here. I got a text during that of where you can find this report, but I think it's a great follow-up just to have Jacqueline send a lot of these things out. But where would advisor access some of these reports?
Well, we'll have them up on Jacqueline can send it to you. If you want this, just put down number 2 and send her an email. If you want the Social Security stuff, put number 1. And if you want the fact sheet, number 3. What's not available is my $100 bill that I use. Cheney needs to get me one of those. I had a lot of wear and tear in the production of this video. I see another $100 bill.
Very nice. Well, any questions as we go ahead and post them there. Really insightful. This is definitely a webinar to go back and probably watch a few times, select some snippets, pull out some best practices and use them. But you can see why Drew attracts great clients, and a lot of them year after year after year, and he keeps his existing clients. It's different than things that you've probably been doing before. And this is the kind of level that if you want to be working with people with multiple millions, this is the kind of stuff that is really going to take it to the next level. So tremendous insights on doing some new different things with existing people, taking it to the next level, a lot on how to beat the competition out there. We're going to be talking some more about this down in Miami. I see some of you on here that are going to be down there with us next week at the Becoming Barons event. Our segments on beating your competition are always very, very popular, and I think these Vanguard ones are very, very insightful. And I think what you said, Drew, that hey, I wouldn't mind paying someone a little bit if the end result would end up giving me more. And I think that's exactly what people need to feel. The average person sometimes just looks at short term that hey, I'll take the low cost provider, but do you really want your low-cost provider on something this important? Do you want the low-cost provider providing the airbags on your car, or do you want ones that are going to work? So there's a lot of great analogies, a lot of great things that came out of here today. But I think, again, this is one to go back and pull some things out of. I think these follow-up items will be really good. And, Jacqueline, these would be great things to send out to all of D2 for sure. So, Drew, any final thoughts and insights before we wrap her up and get ready for Miami?
No, I've got a super one coming up, but you're gonna have to go to Miami to see that, because I think what you said brings up a really good analogy. I would say go to your frame shops and ask the frame guy, have they ever had somebody bring in a masterpiece and they put a 10-cent frame around it.
Such a great one. Such a great one. Well, we look forward to seeing.
Well, John, here's what I was looking it up, and I wanted to basically say it. Here's how you compete with Vanguard. Everybody's heard about the space program, correct? The manufacturer that built the Saturn V rocket did not build the parachutes that got it back to Earth. So what got you there may not get you here.
That's a great one.
This is where I would drop the microphone if I was.
I agree. I agree. Well, excellent one today. Go back and watch this one for sure. This is a lot of great stuff. So Miami next week, we'll see a lot of you there. I see some people on here that couldn't make it, some schedule conflicts, spring breaks. We'll see you in Charlotte after Thanksgiving. But next week, get ready for Miami. Lots of great insights on Wednesday in the investment forum in the afternoon. All day Thursday, we're going to learn from Bob Bonfiglio, Audrey Begay, tremendous Barron's advisors. We're going to learn what got them there, what you can copy, and where they're going next. So thank you, Drew, as always. Thank you to all of you in D2. Stay bullish, and we'll see you in Miami next week.
See you, John.